The majority of our questions can be answered using Pub 4012 or Pub 4491. There are times we will need to search further for answers by utilizing Pub 17 or irs.gov. The goal today is to assist you with where to go to find answers to the questions on the test, not necessarily to give you the answers. Also, keep in mind during these tests that although we do not file taxes for clients who need to file as married filing separate, and that's because Wisconsin is a marital property state, we still need to answer the questions as if we do. There are some important sections of Pub 4012 and Pub 4491 that should be read entirely before beginning your test. In Pub 4012, be sure to study how to use this guide and legislative extenders. In Pub 4491, make sure you read fully sections Important Changes for 2021 and Temporary Provisions. Please turn to page 74 in your test retest booklet, Pub 6744. Karen White. Karen's husband, Fred, moved out of their home in April of 2021. She has not heard from him since. Karen and Fred are not legally separated. Karen has 2 children, Avery, 12, and George, 15. She will claim them as her dependents on her 2021 tax return. Karen is 38 years old. She earned $28,000 in wages, $175 in interest, and $12,500 of unemployment income. Karen made a cash contribution of $650 to the Red Cross. She does not have enough deductions to itemize this year. Karen paid all the costs to keep up her home and to support Avery and George. Karen received her 3rd economic impact payment of $5,600 based on her 2020 tax return filed jointly with her husband. They are all United States citizens and have valid Social Security numbers. Karen, George, and Avery lived in the United States all year. The first thing we need to think of is what filing status should she use when filing? Open your Pub 4012 and follow the chart on page B8. If you are still uncertain, you can continue to the pages following. You can also find more information in Pub 4491, beginning on page 41. Let's start at the beginning. We know she was married at the end of the year. We follow this over to, did you and your spouse live apart all of the last 6 months of the year? They were separated for 7 months, so we need to follow the yes arrow down. Do all of the following apply? She will file a separate return from her spouse, yes. She paid more than half the cost of keeping up her home, yes. It was the main home for her children, yes. And let me note here, grandchildren do not meet this test. And finally, she can claim her children as dependents, yes. We follow that through and see that her correct filing status will be head of household. You may wonder why it would not benefit her to file as married filing separate. There are many reasons. Here are just a few. The tax rate is generally higher than on a joint return. Taxpayers cannot take the child and dependent care credit, education credits, and certain other benefits and credits. Some credits and deductions, such as the child tax credit and the retirement savings contribution credit, are reduced at income levels that are half those for a joint return. If a taxpayer is married filing separately and the spouse itemizes deductions on their return, the taxpayer must itemize and cannot take the standard deduction. There is a difference in the standard deductions. Married filing separate is $12,550 and head of household is $18,800. Let's talk a little bit about her financial information to determine what is taxable and what is not. Please turn to tab D, page 1 in your Pub 4012. She received wages, which is earned income, that's taxable. She received interest, which is unearned income, that also is taxable. Unemployment income, which is also unearned income. For tax year 2020 only, the first $10,200 of unemployment income was not taxable. This does not hold true for tax year 2021 at this time. Unemployment is taxable. She also received a third economic impact payment of $5,600. This can also be called her stimulus payment, and it is non-taxable. She received $5,600 for her economic impact payment. Did she receive the correct amount? On the bottom of page H8 in our Pub 4012, we can see that she is due $1,400 for herself and also for each of her two children. That totals $4,200. The additional $1,400 was included in her payment for her estranged spouse. What do we need to tell her about the overpayment? Refer to the handout. TaxSlayer did not charge for returning the excess payment in 2020 software, and I am assuming this will be the case for this tax year. This is the actual screen from TaxSlayer. In Pub 4012, they needed to use last year's screen for the recovery rebate credit when sending to the printer because the software had not yet been updated. But this is how it will look in the software. For more information, use Pub 4491, two sections, one beginning on page 28.1 and the second one on 28.5. As part of her expenses, she paid $650 to the Red Cross as a cash contribution. In 2020, the maximum amount allowed to be deducted was $300 per return. Please turn to page F10 in your Pub 4012. As you can see, the $300 adjustment to income was changed to $300 per taxpayer. In other words, for a joint return, $600 will adjust off the taxable income. In Karen's case, however, she can only deduct $300 because she is not filing a joint return. More information is available in Pub 4491 under Temporary Provisions. Pub 6744, Test Retest, page 76. Paul and Maggie Thomas. Paul and Maggie are married and want to file a joint return. Maggie is a U.S. citizen and has a valid Social Security number. Paul is a resident alien and has an ITIN. They resided in the United States all year with their children. They have two children, Cheryl, 4, and Mike, 15. Both Cheryl and Mike are United States citizens and have valid Social Security numbers. Paul earned $18,000 in wages. Maggie earned $20,000 in wages. In order to work, the Thomases paid child and dependent care expenses of $3,500 for their daughter Cheryl to attend Busy Bee Child Care. Paul and Maggie provided all of the support for their two children, and they declined to receive the advance payments for the child tax credit. Let's talk about the child tax credit. Paul has an ITIN. On page 24.3 of Pub 4491, we read, taxpayers claiming the child tax credit must have a valid identification number, Social Security number or ITIN, by the due date of the tax return, including extensions. In addition, the dependent claimed must have a valid Social Security number by the due date of the return, including extensions. Taxpayers cannot subsequently file amended returns to claim the credit for a year that they did not originally have a valid identification number by the return date. His ITIN does not eliminate this credit. Now we'll go on to find out about the children. Turn to page G2 2 in your Pub 4012 to find the rules on the credit. Look at the bottom section with the rules to be a qualifying child. Both children are under 18, and note this is a change from under 17 as it has been in the past. This change is for 2021 only at this time. Both children are United States citizens. They both will be claimed as dependents, and they are their children. They did not provide over half of their own support, and they lived with the taxpayers more than 1/2 of the tax year. They both have Social Security numbers. And just as an aside, if the child would have had an ITIN, that child was not eligible for the child tax credit. Now that we have determined that Thomases qualify for the child tax credit, let's determine how much they should be receiving. In this same section above the qualifying child list, it reads, for tax year 2021, families claiming the child tax credit will receive up to $3,000 per qualifying child between the ages of 6 and 17 at the end of 2021. They will receive $3,600 per qualifying child under age 6 at the end of 2021. So Cheryl, who is 4, would receive $3,600, and Mike, who is 15, would receive $3,000. That would be a total of $6,600. How about the child and dependent care expenses? Please turn to Pub 4012, page G12. The maximum amount that can be used to calculate this credit for tax year 2021 only has increased to $8,000 for one qualifying person, with a maximum of $16,000 for multiple individuals. See the bottom of page G12. Last year, the credit allowed expenses of $3,000 for one individual, with a maximum of $6,000 for multiple individuals. Pub 6744, test retest, page 76. Carol Wheeler is age 56 and is single. She earned wages of $48,000 and was enrolled the entire year in a high-deductible health plan, also known as an HDHP, with self-only coverage. During the year, Carol contributed $3,000 to her health savings account, and her cousin also contributed $1,000 to her health savings account. Carol's Form W-2 shows $600 in box 12 with the code W. She has a Form 5498-SA showing $4,600 in box 2. Carol took a distribution from her HSA to pay her unreimbursed expenses, which include 2 visits to a physical therapist due to a car accident for $300, unreimbursed doctor bills for $700, prescription medicine for $400, replacement of a crown $1,500, over-the-counter sinus medication for $80, and 10 Zumba classes for $125. Carol is a United States citizen and has a valid Social Security number. We are going to talk about Carol's HSA. IRS Form 8889 is used to report HSA information. There are 3 sections to this form. TaxSlayer puts the figures in the appropriate field by our entries. Part 1 reports all contributions, whether they be from an individual or any other person, which could be an employer or family member, on behalf of an eligible individual. Part 2 reports any distributions, whether qualified or not. It is up to us and our interview process to determine what expenses are qualified. If they take money out for expenses that cannot be considered medical tax-free distributions, they will need to pay tax on those amounts. Part 3 is out of scope for VITA. Let's talk about how much Carol can put in her HSA for 2021. Pub 4012, page E7, says to be an eligible individual and qualify for an HSA, Carol must meet the following requirements. She must be covered by a high deductible health plan on the first day of the month, which she is. She cannot be covered by any other health insurance. She cannot be enrolled in Medicare, and she cannot be eligible to be claimed as a dependent on someone else's tax return. It appears that Carol is indeed eligible to participate. Now, how much can be contributed this year? The limits are noted on this same page. Carol is over 55, therefore she can deposit an extra $1,000, which is added to the limit of $3,600 for a self-only plan. She deposited $3,000 personally. Her kindly cousin deposited $1,000, and another $600 from her wages came out automatically, making the total $4,600. Qualified medical expenses from Pub 4491, beginning on page 1712. The taxpayer can receive tax-free distributions from an HSA to pay or be reimbursed for qualified medical expenses incurred in the current or prior year, but after the taxpayer establishes the HSA. Qualified medical expenses include the medical expenses of the taxpayer, their spouse, or a dependent at the time the expense was incurred. It does not matter whether the taxpayer has self-only or family HDHP coverage. Qualified medical expenses are expenses that generally would qualify for the medical and dental expenses deduction. Examples include unreimbursed expenses for doctors, dentists, and hospitals. In addition, over-the-counter products and medications are now reimbursable without a prescription, as well as menstrual care products and PPE, which is personal protective equipment, products for coronavirus safety. We need to look again at her expenses. Are all of her distributions qualified expenses? A more detailed list can be found on page F5 of Pub 4012. Physical therapist, yes. Unreimbursed doctor bills, yes. Prescription medicine, yes. Crown replacement, yes. Over-the-counter sinus meds, yes. Zumba classes, not a chance. If we total up her qualified expenses, they come to $2,980. Here are samples of the two forms associated with HSA's Form 5498-SA that shows us the contributions, and the Form 1099-SA shows us the distributions. Pub 6744, test retest, page 78, Barbara Jacobs. Barbara is 57 and was widowed in 2021. She owns her own home and provided all the cost of keeping up her home for the entire year. Her only income for 2021 was $36,000 in W-2 wages. Jenny, age 24, and her daughter Marie, age 3, moved in with Barbara after she separated from her spouse in April of 2021. Jenny's only income for 2021 was $15,000 in wages. Jenny provided over half of her own support. Marie did not provide more than half of her own support. Jenny will not file a joint return with her spouse. She did not receive advanced child tax credit payments for 2021. All individuals in the household are U.S. citizens with valid Social Security numbers. No one has a disability. They lived in the United States all year, but not in a community property state. This is always a tough one. Let's start on page C1 and we'll go down the chart for both Barbara and Jenny. We'll start assuming that Barbara would want to claim Jenny. Number 1, Jenny is her child, yes. Number 2, Jenny is not under 19. She's not a full-time student or disabled. Barbara cannot claim Jenny. Now we'll start again with Barbara possibly claiming Marie. Marie is a descendant of her daughter. She is under age 19. She did live with Barbara more than half of the year. She did not provide her own support. Marie is not filing a joint return, and Marie could be the qualifying child of more than one person because we're not sure if she's a qualifying child for her mother Jenny or not. We will need to check on that, but let's go on to see if maybe Jenny can claim Marie. Marie is Jenny's daughter. She's under age 19. She lived with Jenny more than half the year. She did not provide her own support. She is not filing a joint return. Again, Marie could be the qualifying child of more than one person. It looks as though both Jenny and Barbara could possibly claim Marie as a dependent. Now let's look at the bottom of page C2 in Pub 4012. If a parent can claim the child as a qualifying child, but no parent claims the child is treated as the qualifying child of the person who had the highest AGI for the year, but only if that person's AGI is higher than the highest AGI of any of the child's parents who can claim the child. If the child's parents file a joint return with each other, this rule can be applied by dividing the parents' combined AGI equally between the parents. Now, example, your daughter meets the conditions to be a qualifying child for both you and your mother. Under the rules above, you are entitled to treat your daughter as a qualifying child for all of the 6 tax benefits listed above for which you otherwise qualify. Your mother isn't entitled to take any of the 6 tax benefits listed above unless she has a different qualifying child. However, if your mother's AGI is higher than yours, you can let your mother treat your daughter as her qualifying child. If you do that, your daughter is not your qualifying child for any of the 6 benefits. Jenny will be filing as married filing separate and would not typically be able to receive the earned income credit, a child and dependent care credit, and the child tax credit would be reduced. There is an exception regarding the earned income credit. On the bottom of page I-1 in Pub 4012, and again on page 29-2 in Pub 4491, it states, taxpayers can claim the earned income credit who are not married, not filing a joint return, had a qualifying child living with them for more than half the year, and either lived apart from their spouse for the last 6 months of the year, or are legally separated according to state law under legal separation agreement or a decree of separate maintenance, and did not live in the same household as the spouse at the end of the year. When we read this exception, it looks as though if Jenny did claim Marie, she would still qualify for the earned income credit. Pub 6744, test retest, page 79. Michael Block. Michael is 49 years old and files as single. His 2021 adjusted gross income, or AGI, is $49,500, which includes gambling winnings of $1,000. Michael would like to itemize his deductions this year. He brings documentation for the following expenses: $8,200 hospital and doctor bills, $700 in contributions to his HSA, health savings account, $2,500 for long-term care insurance premiums before age limitation applied, $3,400 for the state withholding. It's higher than Michael's calculated state sales tax deduction, $300 in personal property taxes based on the value of a vehicle, $400 for his friend's personal GoFundMe campaign, $275 cash contributions to the Red Cross, $100 fair market value of clothing in good condition donated to the Salvation Army. Michael purchased the clothing for $800. $7,500 in mortgage interest, $820 in real estate tax, $230 for mortgage insurance premiums, also known as a PMI, on a home that he purchased in 2017. $150 for homeowners association fees, and he had $2,000 in gambling losses. Page F3 of Pub 4012 begins the section on general itemized deductions. More information can be found beginning on page 20-1 of Pub 4491. Let's use Pub 4012. I will be giving you additional pages to mark down in your test booklet that will correspond with other expenses. Question number 1, did he have qualifying expense? Yes. Number 2, were the medical and dental expenses paid pre-tax or from an insurance company? No. Number 3, were his medical expenses more than 7.5% of his AGI? His AGI was $49,500. 7.5% of that is $3,712. His hospital and doctor bills were $8,200. So he does have expenses more than 7.5% of his AGI. You can go to page F6 for more information. Also on F6, you will find information on the long-term care insurance expense that does have limits. Question 4, did he pay taxes? He had state withholding. Make sure you look at page F8. He had personal property taxes on his vehicle, F7, and also on F7 are his real estate taxes. And when we look at these real estate taxes, we are assuming there are no other additions to these taxes, such as garbage removal or special assessments. Number 5, did he pay these taxes during the tax year? We're going to assume yes. Does he have a home mortgage loan? Number 6, yes, he does. We will continue on with page F4, the page following. Question 7, was this mortgage on a main or second home? We are assuming yes. Number 8, did he pay mortgage interest in the tax year? Yes, he did. Number 9, did he take out the mortgage on or before October 13th, 1987? No, he did not. So now we need to determine if his interest is deductible. Please follow along on your handout. Does he meet the conditions in footnote 1 to deduct a home mortgage interest? And that would be, you must itemize deductions on a Schedule A, Form 1040, which he's doing, and the loan must be a secured debt on a qualified home. And we are assuming that home was qualified and the debt is secured by the home, so yes. Now, was his mortgage taken out on or before October 13th, 1987? No, it was not. Were his mortgages taken out to buy, build, or substantially improve his main or second home? The fact that the interview notes do not address this, we will assume that this is true, that the answer is yes. Was his mortgage balance less than $375,000? Again, we will assume that this is true. Mortgage interest was purchased on his home in 2017. Now, if we follow along this chart as we just have, we do see that this expense will be deductible. Now we'll go on back to question number 10. Did he pay mortgage insurance premiums? Yes, he did. More information is on page F9. Question 11, did he pay points? No, he did not. Question 12, was his interest used to buy, build, or improve his home? Again, the fact the interview notes do not address this, we will assume it to be true. His home mortgage interest is deductible. Number 13, did he make cash contributions to a qualified organization? He made a cash contribution to the Red Cross, which is a qualified organization. He also made a cash contribution to a GoFundMe campaign. That is not considered a qualified organization. It's considered an individual. You can get more information on that on page F10. Question 14, did he make a non-cash donation to a qualified organization? Yes, he did. He gave clothing to the Salvation Army. Again, you can go to page F10. Number 15, is the total of all non-cash donations $500 or less? See the note 3 on the bottom of this page for the definition of qualified organizations. If you have been marking off the expenses presented, you will see we have dealt with all except the following: $700 contributions to his health savings account. That is not an itemized deduction. See Pub 4012, page E1. Also, you can get more information on page F5. The $150 for his homeowners association fees, go to Pub 4491, page 20-4, and also on 4012, page F10. $2,000 gambling loss, Pub 4012, F11. Remember, his losses are only deductible up to the amount of the winnings. Pub 6744, test retest, page 80. Sean Dennison. Sean is 19 years old. He is not a full-time student. He works at a grocery store and he earned $20,000 in wages. He had $2,400 of withholding. He lives with a friend in a rented apartment. They each pay their own expenses. Sean provides all of his own support. Sean is a U.S. citizen and lived in the United States for the entire year. He has a valid Social Security number. What do we know about Sean's filing status? Does he need to file a return? Let's look at the chart in Pub 4012 on A1 for who needs to file. More information will be found in Pub 4491 beginning on page 3-1. He's single, under the age of 65. He must file a return because his gross income was over $12,550. He's pretty young, but he does have earned income. Is he allowed to claim the earned income credit on his 2021 return? Let's start in Pub 4012 on page I-1. More information can be found in Pub 4491 beginning on page 29-1. He does have taxable income. Please look at the notes section on the bottom of this page. It reads, we will be able to use the 2019 earned income when calculating the earned income credit if that income is higher than the 2021 earned income. We cannot go back to 2020 for the earned income. Go to page I-2 for more rules. This is page I-2 from Pub 4012. More information is available in Pub 4491 beginning on page 29-1. This is also addressed in temporary provisions in Pub 4491 on page 2-3. Part A shows us the rules for everyone. He has a Social Security number. He is not filing as married filing separate. He is a United States citizen. He does not have foreign income. He does not have over $10,000 of investment income, and he is not the qualifying child of another person. He does meet the rules for everyone. Now we need to go on. Part B is for taxpayers who have a qualifying child. He does not, so we go on to Part C. It's for taxpayers without a qualifying child. He is at least 19 years old. He is not a dependent of another. He lived in the United States more than half the year, and he is not the qualifying child of another person. He does meet the rules without a qualifying child. The temporary provisions section of Pub 4491 has a typo in it. I have it here in red, where it says enrolled in school should be crossed out. The correct wording is found on page I-2, footnote 3 on the following page. Remember, this is a temporary provision for tax year 2021 at this time. We are back to page I-2 in Pub 4012. We need to go on to Part D. He is filing single and does not have a qualifying child. The maximum amount of income is $21,430. His income was $20,000. His income is below the limit for filing without a qualifying child. So therefore, he does qualify for the Earned Income Credit.